Let's work a few exercises in these equity transactions, and then I think it'll probably make a little more sense to you. Here we have common stock that's issued, and notice up here they say it is previously unissued. That means we're not issuing out of the treasury, we are issuing stock that we are authorized to issue, and this is the initial offering of those shares. It is a par value of dollar. Again, that's an arbitrary amount. We just need it for our journal entries. And the price of the stock is 50, which you can calculate how much cash we're going to get in, can't you? 1,000 times 50. If you like to go through this accounting equation and do the analysis, you can. Personally, I think you should probably be very familiar or feel very comfortable just jumping into the journal entries. The debit to cash, the cash coming in, is $50 times 1,000 shares. The common stock is only going to be credited for par times number of shares, which is $1 times 1,000, which is $1,000. And then the additional paid-in capital can be calculated two ways. You could take the 50,000 minus the 1,000 to get it, or you could go in and check your numbers and say 50 minus 1 is 49 times 1,000 gives us 49,000. Either way, you're going to get the right answer. Well, how would your number be different if the par was $2? Well, of course, the effect would be different when we do the journal entry, because when we do it, we're going to see instead of having common stock going up by 1,000, the common stock is going to go up by 2,000. And since additional paid-in capital is a remainder amount, if you want to look at it that way, it's going to be 48,000, so it is going to change as well. So the amount of cash coming in would stay the same, only the amounts would be distributed different between the two contributed capital accounts, common stock, and paid-in capital common stock. NetPass has 300,000 shares of common stock authorized, 270,000 shares issued, and 100,000 shares of treasury stock. And then they are going to declare a dividend of $1. Now the key to all this, they want to know what is the total amount of dividend to be paid. It's $1 per share of common stock. Let us assume that they have no preferred stock requirements, and so they don't have to worry about paying preferred stockholders any part of this dividend. All of it would go to common. Let's just make that assumption. We should know now that the dividend per share only goes to outstanding shares. So the key to answering this question is calculating the number of outstanding shares. Is the number of outstanding shares to 300,000? No, that's the number authorized. Is the number of shares 270,000? Well, these were initially issued, so the cumulative amount of issued shares is 270,000, but are all the 270,000 issued still outstanding? The answer is no, because 100,000 have been bought back into the treasury, so we really only have 170,000 outstanding. Because 170,000 are the outstanding number of shares and it's $1 per share, then the dividends paid would be $170,000. This is an example where you probably need to print out the PowerPoint slides before we start working the problems, because in the voiceover you're going to have maybe you'll have a difficulty looking at the results. We're going to show the stockholders' equity section after these transactions, and it's sometimes helpful to be able to look at the transactions and work through them to see the effects as each incremental effect from the transactions will have on the balance sheet. Now, preferred stock is authorized 8%, $10 par, 20,000 shares. Now, why do you suppose we show this 8%? It's because it's how we are going to calculate the dividends that are on preferred stock. So the dividends on the preferred stock are going to be calculated as 10 times 20,000 or 200,000, and it's going to be 8% of 200,000, which I believe is $16,000. Common stock, we need to know the par on it so we can divide it into the paid-in capital and the common stock account when we issue it. Likewise, the par is also going to be needed with the preferred stock so we can split the differences in between the two contributed capital accounts, preferred stock and paid-in capital preferred stock. The first transaction has us issuing 40,000 shares of common stock for $15 per share. In this transaction, you know that since the common stock has a par of $1, we are only going to take 40,000 times 1, or $40,000 into common stock from this transaction. The remainder is going to go to paid-in capital common stock. So the $14 per share times the number of shares for paid-in capital common stock. The second transaction, 10,000 shares of preferred stock, $16 per share. The par on this is a little higher. It's $10 par. So 10,000 times $10, or 100,000, will go to that preferred stock account, the remainder to paid-in capital. In the third one, we are issuing both common and preferred in one transaction. And so you'll need to work through this just as you have on A and B. In D, we have net income. When we have net income, you have to understand that this is going to affect us through which account? Retained earnings. And they say prepare the stockholders' equity section. So I'm going to try or attempt to talk us through this so that you can see where the numbers are coming from. The 11,000 shares issued and outstanding. Now, this is important. The shares of preferred stock were issued and they were outstanding. They were not bought back into the treasury. Now, how do you get the numbers over here to work? Well, generally you take the number of shares issued times the par to come up with a number. I see this is not right. There's a problem with that. The paid-in capital account will be adjusted for the outstanding, for the preferred capital is going to be $6 difference between the market and the par is going to be $6. Initially we had 10,000 and then we also issued another 1,000, so it's 11,000 shares for the amount above market price. The common stock here, we have authorized 50,000, we issued 43,000, and these are all issued and all outstanding. It was done in two transactions, the 40,000 and then the 3,000. And the difference between the market price and the par goes into paid-in capital common. If the market price changes, then the amount each time going into paid-in capital will differ. In one instance it was 15, in the other instance it was 20. So that differs. This one I want to tell you is correct because you can see issued times par is 43,000. Okay? This one is 11,000, $10 par. Yes, I guess it was right, 110,000. So total contributed capital is the total of this amount. Retained earnings only reflects the net income for the time period. Ava School of Learning obtained a charter authorizing it to issue 50,000 shares of no par common and 20 of preferred stock. The preferred stock has a par, the common has no par, and so we're going to work our way through the journal entries. And it says collected cash from individuals and issued. What they're saying is that they sold common stock to individuals, for individuals, and it doesn't matter the number of individuals, it only matters the number of shares of stock. The other thing is we have to think about par. Is there par? There's no par. If there's no par, there's no paid-in capital. So we have three transactions, and after the journal entries, then we're going to do the stockholders' equity. So this one will probably make more sense to you. no par. No par. So only market price times 5,000. It all gets in common stock. There's no paid-in capital account. Again, no paid-in capital account. This one did have a paid-in capital, and the paid-in capital account and the par on the paid-in capital should be $10. So half of the 20 is going to par. It's very arbitrary. You notice in some of our problems, our main account for the preferred stock or common stock, when we did this transaction, the amount we put in was very small. It might have been a penny par. And then the most of it, I think one transaction we had $19.99 times the number of shares going to paid-in capital, and only a penny times the number of shares going to the stock account. So it's very arbitrary, and you may come up with some very strange combinations when you do the journal entry. It will all be fine as long as you can go back and you can multiply par times the number of shares of stock to come up with that number, and you can do market minus par to come up with the additional paid-in capital. When you do the stockholders' equity account, again, I want you to see issued times par is this number. And here we have 50,000 shares which are authorized, 26,000 shares issued and outstanding. If there's no par, you can't multiply across to get this number. It's going to be only the market price times the number of shares for each one of the transactions. Additional paid-in capital comes about only from the preferred because there's no par on the common, so it's only coming from preferred, and it's the difference between market and par. Here are some treasury stock transactions. Always a lot of fun. You just have to remember to not take it in at par, but to take it into the treasury at its purchased value. First transaction, we're buying $8,000 worth of stock. The second transaction, we are selling those, and if we sell those for a greater value than we bought them at, then we are going to have additional paid-in capital. And here they did it properly. They put the caption treasury for treasury stock. Now, in this last transaction, we are selling stock, and the additional paid-in capital account is going down. So let's look at the individual journal entries then. In the first one, buying back the treasury stock at $20 a share. In the second transaction, selling the stock for $5 more per share, which means we have paid-in capital to report. On the third one, we sold the stock, but we sold the stock at $15 a share, which was less than we paid for it. And you're going to say, well, aren't we worse off? And I'm going to say, yes, we are definitely worse off, because we paid $20 for something, and then we are going to turn around and get rid of it and only get 15. So we lose 5 in this transaction. We don't call it a loss. We call it an adjustment to additional paid-in capital. The caption, again, should probably be additional paid-in capital treasury stock. This should also be additional paid-in capital treasury stock. We will probably keep those separate because we want to show them separately in our financial statements. What impact does the purchase of treasury stock have on dividends paid? Well, we do not pay dividends on treasury stock. But as you saw from a previous slide, that if you take amounts of stock back into your treasury, you are going to reduce your outstanding. And what are dividends paid on? Outstanding. And he asks for the effect on net income. No effect on net income. But what it does, it will affect us because it will change the amount of cash which we have from the whole transaction. Here we have dividends and a statement of retained earnings. And so the company is going to declare and pay preferred dividends. It's declaring and paying dividends on common stock, and it has a number of shares of common outstanding, issued, and a number in treasury. So my bet on this one is you're going to have to figure out how many outstanding we have. If you have a million authorized and 300 are issued and 100 are in treasury, you know to jump to the number of issued minus treasury to get outstanding. So it's issued minus treasury to get outstanding. Preferred stock transaction. Anytime you declare dividends, you create a payable. Okay, so we create a dividend payable and we debit dividends. When we pay those dividends, we remove the liability. The dividends, the amount which is going to be closed into retained earnings, it comes about on the date of declaration, not on the date of payment. For common stock, we have those, and we calculate again, as I said, you take issued minus treasury to get outstanding. Dividends per share of $2 per share means 400,000 will be dividends. Again, record dividends payable on the declaration date, and the dividends payable will go away then on the payment date. So when does it technically affect retained earnings? On the declaration date, because that's when we are going to put it in the dividends account, and that's when it's there, and it will later be closed into retained earnings at the end of the month. The statement of retained earnings then should reflect both of those dividends, the dividends to preferred and the dividends to common, and both of these dividends are reductions in retained earnings for that year. Closing the dividends account is done at the end of the year. We're going to close our dividends. It has a debit balance because we debited dividends and we credited dividends payable on the declaration date. We remove dividends by crediting it and debiting retained earnings.